Sameer Arora as well as Akash Prakash are right here with me from Singapore.
Coming to you live via brand new technology that we are trying to get you in Indian television, and that's the hologram.
Your set is very energetic. I must compliment you for that.
Welcome on the show, Graham.
Arun Subramaniam, Chief Economic Advisor.
It could be a muted start on Wall Street as the US adds only 156,000 jobs in December. Across the world, equity markets are clutching at straws after the disappointing non-farm payrolls. Here at home, markets pull back from a two-month high as investors hit the sell button in the last hour. The Nifty ends below 8250 after touching 8300. A slump in technology shares on worries over H-1B visas outweighs positive global cues. Pace of GDP growth is bound to slow down for the first time in 3 years after the Central Statistics Office pegs FY17 GDP growth at 7.1% as against 7.6%. And analysts worry that we could be headed for sub 7% growth given that these estimates haven't pegged in the impact of demonetization. The government moves to allay fears over triple taxation for foreign funds. The Revenue Department clarifies on sticky issues after DEA's frequently asked questions creates quite the flutter. And it's a setback for Aircel. Supreme Court rules it cannot sell its 2G license to REL Communications. For now, demands that the promoters of Maxis be present before the court in the next hearing, failing which the license may cease to exist. Hello there, good evening. You've joined us right here on Smart Markets. I'm Tanya Bharadwaj, and we'll start this evening with a check on what went down on trading floors today. And let's just say yesterday's euphoria somewhat faded away, with markets today pulling back from a two-month high. Profit booking, as the intraday graph will tell you, especially in the last hour of trade, meant that you saw the Sensex take a 120-point haircut, while the Nifty ended below 8250 after actually taking a shot at 8300 in intraday trade. IT stocks today really bearing the brunt of selling, the index collapsing almost 3% as visa worries have resurfaced. Remember, the immigration reform in the US has been introduced in the House of Representatives by the Congress, which is likely to be a big overhang on the sector. And then you have TCS and Infosys that will also kick off earnings season next week. So, of course, a fair amount of caution ahead of that as well. Banks today, though, actually found some decent traction, and the star performer was Yes Bank. It gained a good 3% after Motilal Oswal said that it actually expects the outperformance by this private lender to continue well into the calendar year. In fact, they think that there is room for a further 20% upside from those levels. So Yes Bank finishing off in style, up about 3%. For the week, well, on the benchmarks, nothing really to write home about. Both the Sensex and the Nifty just gaining a little less than 1%. But the broader markets, well, that's really where the story, lay. The Nifty mid-cap surging a good 3.5%. The small cap index also seeing similar gains. You have metals, autos and infrastructure in the week gone by. They've seen a little bit of pressure, down anywhere between 2 to 5%. So that's, of course, as far as the local story goes. But let's talk about what's happening globally. Remember, today you have very important macro cues, non-farm payrolls, where you're seeing the fact that US job growth has slowed slightly in December, with the economy adding 156,000 jobs in December. The poor December numbers, you could argue, will probably be offset by a revision to the November print that's been revised higher from the earlier 178,000 to 204,000. The unemployment rate at 4.7%, pretty much, as predicted, but yet a smidge higher from last month's 4.6%. But the silver lining in this jobs report is the jump that you've seen in average hourly earnings, which have risen 0.4% in December. On an annual basis, that's about 2.9% from the earlier 2.5%. Let's take a look at, how stocks on Wall Street are reacting to that. It was pointing to a pretty muted start, at least as far as futures go, and that's pretty much what you're seeing the Dow do right now. It's opened flat down some 20 odd points. Let's chat a little bit more with Gurraj Singh, Sangha, who's joining in on the phone line. He's, of course, a senior global macro portfolio manager, and he joins in on the phone line from New York. Gurraj, good evening. Thanks for taking time out for us. First, the 156,000 jobs addition, not as good and robust as expected, but the, wage growth is definitely encouraging, wouldn't you say?
Yes, as you mentioned, it's certainly, when you take into account the revisions, it's more or less in line with what was expected. The average hourly earnings is certainly a boost, and that's something that's interesting because that's one particular item that the Chairwoman Federal Reserve, Janet Yellen, takes very close attention to. And net, the Fed's looking at raising rates about 3 times this year. That trajectory is more or less on track. I mean, there are other factors in the world, particularly what's happening in China, which may change that trajectory, but the jobs report isn't going to change the Fed monetary policy at this point.
Interesting that you say the 3 anticipated rate hikes on track as things stand. 2 things that a lot of folks in the market are talking about. One, the fact that you've seen the dollar, run pretty sharply. Of course, right now it's coming off those 14-year highs. Do you not see that as an impediment for, the Fed to sort of hike rates? That's one. And the other thing is the surging Chinese yuan, because China seems to be doing everything to sort of fix its currency before the Trump administration takes over. How do you see both these factors sort of playing out?
Right, absolutely. The strength of the dollar over the past year, in and of itself, acts as a tightening of monetary policy because what ends up happening is the U.S. is essentially importing deflationary pressures from the rest of the world and exporting inflation. And given where the emerging markets are at this point and what's happening in China in particular with capital flows continuing, those are factors that the Fed has been looking at closely, but has decided in the near term to try to bring their monetary policy, the U.S. monetary policy, to as normal as possible, to essentially create as much room as possible in the event that global factors such as China or U.S. domestic factors cause the U.S. growth to be impacted, and therefore, if they've raised rates as much as they can, it allows them room to then lower rates. And having said that, what's happening in Europe is also another factor that the U.S. Federal Reserve would take into account with the upcoming European elections, because it's also caused capital to move out of Europe into U.S. and U.S. dollars and added strength to the U.S. dollar. So those are certainly factors that the Fed is taking into account, but has decided at this point they don't need to change monetary policy.
Gurraj, we leave it at that. Thank you so much for taking time out for us. So Gurraj saying that at least as things stand right now, it seems that the Fed is on course to hike rates 3 times this year. As we speak, of course, the Dow not doing much as far as a reaction to the jobs data is concerned. The Dow down now some 30 odd points. Let's talk about news here at home, where the Indian economy is slowing down with or without the note ban. At least that's what today's estimates from the government seem to suggest. The government has pegged FY17 growth at 7.1%. Remember, that's a sharp markdown from the earlier estimate of 7.6%. And what's actually worse is that the actual growth could be a lot lower because these advanced estimates haven't taken into account the adverse impact of the note ban. India's chief statistician, TCA Anand, says the detailed information is available only until September and October for most indicators, and so he's justified the decision to not include bank deposits data also in November because of the high volatility.
Financial services, insurance, real estate and professional services. In this category, one of the indicators which is used relates to the growth of bank deposits and credits. data for which was available for the full month of November. But in view of the government policy of denotification of notes, the volatility in the underlying figures, particularly the growth in deposits, was felt to be an outlier, and therefore a conscious view was taken not to include the estimate for November in calculating the estimate. The slowdown is on account of observable indicators which have been available to you and have been published, particularly with regard to index of industrial production, which has shown a slowdown, continued slowdown beyond the first half in the month of October as well, and that is therefore reflected in the overall projection.
7.1% growth in FY17. Is that a tad ambitious, given that everyone believes that the note ban is only going to spell doom for the economy, at least for the next 2 quarters or so? Let's get an expert stink, and we'll start with our consulting editor, Maithili Pustormap.
Prima facie, the CSO's estimate of 7.1 as the advanced estimate of GDP growth for this fiscal does seem ambitious, not just a little ambitious, but rather ambitious, given the fact that we know that demonetization has impacted economic activity in the country. But one must understand that the CSO deals with numbers, and unlike in the past where it used to have 3 quarters numbers before it gave its advanced estimate, this year they had data only for 2 quarters. So they had to extrapolate the data for just 2 quarters for the entire year. So one does feel a strong sense of sympathy really for the CSO and TC Anand, because they really had very little to go by. So prima facie it does seem ambitious, but in reality, since the CSO can go by nothing but numbers, there really is nothing else that they could do. They've done the best they could under very trying circumstances.
It would not really change the budget math significantly, but what it's important to note is that if this particular growth rate is used as a benchmark for any kind of policy formulation, then I think we will be grossly misled in the sense that, you know, a 7.1% growth is very different from a 6.1% or a 6.5% growth. Along with that, there are certain sectoral breakdown also that comes with this release, which also gives some indication which kind of sectors are moving which way. So from that perspective, I think a policy formulation or a budget formulation, whether in terms of, you know, the rural sector needs an impetus, or which particular sector, say a real estate sector, needs an impetus in terms of if it's really slowing down, those kind of cues are taken from this particular estimate.
Okay, meanwhile, the government is moving fast to allay fears over triple taxation for foreign funds. The Revenue Department has been asked to clarify on the tricky issue after CBDT's FAQs of frequently asked questions created quite the flutter. Ruchi Bhatia is joining in from our New Delhi newsroom with more details. Ruchi, we know what the confusion really is all about, but what is it that New Delhi is doing to sort of clear the air on this?
You know, Tanya, the fund managers seem to be a worried lot, and this especially after CBDT came up with that circular on December 21st, clearly saying that if an FPI has more than 50% investment, 50% assets in India, then any investor that has invested over 5% in this FPI will be taxed under the Indian laws, will be covered under the indirect transfer provisions. So that is a cause of worry for a lot of fund managers, especially sophisticated India-bound funds. All FPIs are crying foul. They're saying that this may prove to be a death knell for the sophisticated fund industry that are looking at very specific investments into India. What we understand is that this, in fact, a representation on this was even made to the finance minister, and also a lot of fund managers have written to the Department of Economic Affairs. They are examining the matter at this moment and may even ask the Revenue Department to clarify on some of those provisions. The FPIs are really worried on, higher taxes. They believe this may lead to a double taxation of sorts. They believe that, this would mean that all funds will have to pay a minimum of 50% in local taxes by FY18, and also would mean a higher tax rate that they will have to pay if they keep an investment for more than 3 years. So clearly, higher taxes have become a cause of worry for for FPIs, and they want to avoid this situation at any cost, and perhaps this is the reason that they've sought the Department of Economic Affairs they want them to come into this matter, examine this, and only then the Revenue Department will come up with any clarifications of sorts.
Ruchi, thank you so much for that. Ruchi Bhatia there joining in with what New Delhi is doing on its part to try and clear the air on what's clearly vexing quite a few in the market. Let's slip into a short break, come back and we'll chat with IIFL's Shishir Bajpai, who will